Good morning. Welcome to the National Association for Fixed Annuities continuing webcast series designed to keep your businesses informed during these unprecedented times. I'm Chuck DiVincenzo, President and CEO at NAFA, and today we are pleased to be sharing with you the CARES Act, what it means for you and your clients, presented by our premier partner, Heather Schreiber, founder of HLS Retirement Consulting. She has over 25 years in the financial services industry. Schreiber partners with financial, legal, and tax professionals to build holistic client solutions for retirement. She is a contributor to Retirement Daily and USA Today, has been a keynote speaker at multiple women forums, and a featured speaker at Ed Slott's IRA Advisor and Master Elite conferences. And I also had the pleasure of working with her when she was at Game Plan. So good morning, Heather. Really appreciate you being here today.
Good morning. Thank you so much for having me. Glad to be here. Glad to be online with you again, Chuck. As Chuck mentioned, we are going to talk about the CARES Act today. I'm sure you're getting lots of questions being in the financial space, and some of the topics apply to you likely. So we're going to talk about that today. And what I'll say too, and I've been saying this to a lot of folks that I speak to on a daily basis, is that be careful. This is literally the most fluid piece of legislation that I've seen in my now 27 years in the industry. And by fluid, I mean every day there is a new development. And some of those things are contradictory to what the actual act says. And that's just because this came about so quickly. And so, Treasury, Department of Labor, Small Business Administration has sort of refined the conditions, rules, and so forth. So as I would just say is fluid, what we're talking about today, I think I have the most up-to-date information, but what you'll find is at the end of the presentation, I have what I think is the most valuable part, which is all the governmental agency resources. You really need to be looking at that, and I would encourage you as you're working with consumers to look at it daily, because it does change, and it's had my eyes crossed on several occasions. So let's talk about what it is. The CARES Act, as we know, on January 27th was the official day that the Department of Health and Human Services declared a public health emergency as a result of the coronavirus. And on March 27th, so 2 months later, we had what's called the phase 3 of the stimulus package, and that's called the Coronavirus Aid, Relief, and Economic Security, informally known as the CARES Act, and that was signed into law on the 27th. So again, this is phase 3. That's where we'll spend most of our time today. And there were some other phases. I'll mention one of them briefly as it relates to this, but it was historic. $2.2 trillion in this package is phase 3 alone. 2 other pieces of legislation related to the coronavirus passed right before it. And this piece, the CARES Act, was intended to aid Americans, businesses, and the healthcare system from the economic and health toll of the crisis. It's 880 pages in length. And a lot of it, obviously, we won't cover things about, equipping the healthcare field with PPE and all of that. But what we will talk about are the things that I've been getting lots of questions on, and I suspect that you have, and some things that you just want to know for yourself. So let's start with the stimulus checks. That's one I get a lot of questions on, and as financial professionals, I have no doubt that you do too. There was 300 of the 2.2 trillion, 300 billion of it was allocated to pay most Americans a recovery rebate check. How much is that? I'm not telling you something you probably don't already know if you're reading the news. $1,200 for single individuals, $2,400 for joint filers, and an additional $500 for households that have eligible children under the age of 17. So for example, a family of 5 could potentially receive $3,900. Now there's some exclusions to this. The first being anyone who's claimed as a dependent on another return isn't eligible for this recovery rebate. Estates, trusts, non-resident aliens, and those with income over certain thresholds, which is I suspect some of the folks that you deal with. So let's look at those thresholds. The first is for single individuals. If their income is under $75,000, then they're entitled to the full $1,200. Once they start getting over that threshold, then excess income over the threshold reduces the rebate, the amount of the rebate, by $5 for every 100, such that by the time they're at 99,000 of AGI or more, they aren't eligible. Head of household, a slightly higher limit of 112,500 or less to get the full amount of the stimulus payment over 146,500, they won't be entitled to it at all. And then joint filers, low end 150. If you're under 150 as a joint filer, you'll get the payment. If you're anything 198,000 or more as joint filers, then you're not eligible for it. This is one of the areas that I can tell you has made me cross my eyes on several occasions, because it has changed truly every single day. And I listen as much as I can to the task force briefings, and I've listened to Treasury Secretary Mnuchin talk about this. And some things have changed with respect to how to get those payments more effectively to Americans. And so let's talk about the fine print about those. Either one of the questions I always get is, those that did not file a return because they didn't have to because of their income, are they still eligible? They are eligible. The IRS is trying their very best. And if you've spoken to people, some people are collecting or receiving those checks as early. They started sending them out on Friday. I think that they are saying pending. I think that's going to be pending for a few days, but they are starting to send those out. The folks that they're sending them out to first are those that have filed either 2018 or 2019 returns. If you haven't yet filed 2019, they'll use 2018, because obviously we have an extension on 2019. But if you have direct deposit information on file, that's where they are sending those checks. Folks that don't file a return, or that their only source of income is Social Security income or railroad benefit income. Now they've expanded it as of, I think last night, SSI income recipients, veterans benefits recipients. They were going to have them do what they called a simple return. They've now changed that. So they're trying to send those payments without creating the additional extra step. They do have, this happened, I think, earlier this week. My days all run together now, but they have a non-filer section. So if you go to irs.gov, you're going to see in the very beginning screen, the home page, you're going to see non-filers, enter payment information here. That's for folks that either didn't file returns and they don't have access to any information about them, or somebody, for example, a filer that didn't file a return because they didn't have to, or they're a Social Security recipient getting the 1099 there, but they perhaps might have dependent children that are also eligible in the household. The IRS isn't going to know that without a return or from the Social Security 1099. So those folks would need to go in, enter that information about those eligible children in the non-filer section. There is a lot of Q&A there. I would encourage you to look at it and look at it daily, because it does change. Others with no direct deposit on file, they've been saying, Secretary Mnuchin has been saying that there would be a web-based portal for individuals that didn't have direct deposit on file to enter that information. And he initially said a few days ago that that would be out next week. But now I'm saying that they will possibly they will cut checks. So I still think that might come to expedite people's stimulus checks, but just keep that in mind, that hasn't yet been developed. But there is a new feature that just came out, I think yesterday, called Get My Payment, and it's a portal to check on the status of a payment. So your customers might be interested in that. And again, he indicated that most would be deposited within weeks. He's kind of held true to that. The first payments were, like I said, sent out on Friday, April 10th. The first ones, again, going to those with direct deposit who have filed returns 2018 or 2019. And then they'll work on the individuals that they're more challenged to get, like the SSA recipients, retirement railroad, and so forth, and non-filers. So let's switch over to the unemployment insurance arena. And there were several ways in which unemployment insurance was boosted for what obviously we are seeing record number of claims. $260 billion of the stimulus package under the CARES Act was allocated to this. The first thing it does is it broadens eligibility to include individuals that haven't been eligible in the past, like self-employed, independent contractors, gig workers, and those with limited work history. Those folks are able to file for unemployment insurance. They just need to be able to certify, like they always do, that they have the ability to work, they're ready and willing to work, but have been adversely impacted by COVID-19. And that can come in a variety of ways, obviously, being let go from their job, not being able to, for all of those reasons that you would go for unemployment. The other big significant part of the unemployment portion of the act is that it adds federal benefits on top of state benefits of $600 per week for eligible recipients for up to 4 months. So this is pretty significant. So if someone's getting, a $300 check from their state, then they could essentially receive the 300 plus another 600 for up to 4 months. And that's federally funded. That's what that's $260 billion is going for. It also adds an additional 13 weeks to the regular 26-week max period that's permitted by the states through December 31st, 2020. That's called the Pandemic Emergency Unemployment Compensation, and that's also federally funded. And then if states opt in, which I would hope they all would, benefits can be available immediately without the customary 7-day wait. I know that they're inundated and trying to get through them too, but they're trying their best to get those funds to the American people as quickly as they can. This is another section. There was a section with respect to retirement plans. I'm going to focus on that for a few minutes, and one that I get a lot of questions on, and that is a section that will lift the 10% early withdrawal penalty for retirement plan and IRA distributions as a result of a coronavirus-related event. So what is that as they define it? And the act is defined essentially these three ways. Participant has been diagnosed with COVID-19 by a CDC approved test, or their spouse or someone in the home, a dependent, has tested positive. Or where I suspect most people will fall that want to take advantage of this is someone who has experienced adverse consequences as a result of being quarantined, furloughed, laid off, having reduced work hours, having an issue with trying to find childcare. All of those things, that's sort of the bucket I think that most people will fall into. And then the act says other factors as determined by the Treasury, which to me says there is going to be additional guidance coming. I've gotten a lot of questions about this, whether you can take the money out and then convert it to a Roth and spread it out over 3 years. I'm not comfortable at all with that line of thought because we haven't gotten any guidance yet. The guidance that has come out has been really focused on the small business loan program and the stimulus payment check. So I keep looking to see if there's any additional guidance, but so far not. So the fine print on coronavirus related distributions is that it is a maximum of $100,000 aggregate limit per taxable year. However, it's only available for this year as it's written. It could certainly extend. And the tax liability here is spread ratably over 3 years, but someone can opt to accelerate. So keep in mind that if someone taking this distribution, they're not going to avoid the taxes. If they're under 59 and a half, they'll avoid the 10% penalty, but not the taxes. So the IRS will assume that any distribution taken out under a CRD event will be spread over 3 years, but you can certainly change that up if you would like to. The other significant difference with CRDs is that any monies that aren't used may be rolled back within 3 years from the date of the coronavirus related distribution. Again, this will require additional guidance. How are plan sponsors, IRA providers, how are they going to report all of these things and keep track of it? Yet to be determined. And it is also going to be, regardless of the length of time, as long as it's within that 3 years, it will be treated as an eligible distribution from retirement plans and an eligible rollover. So a lot of folks, that work with 401k plans, for example, know that there's an in-service withdrawal provision that typically only allows distributions of elective deferrals at 59 and a half. This would automatically, under this provision, would lift that requirement for those folks needing the money. It would also not have the mandatory 20% withholding requirement that typically applies to eligible rollover distributions. So they will get the full 100%, but again, still taxable. And it isn't just for people under 59 and a half. It is available for anyone. It just lifts the 10% penalty for those folks that would otherwise be faced with that. And the employee, especially in the plan side, the Act clearly states that the employee must self-certify that one of the conditions applies to them. So it takes the liability off the employer to determine if truly, in fact, they have a CRD. Again, that's why I'm waiting patiently for additional guidance from the IRS, because we just want to make sure that we're educating our clients about what the conditions really are and how to self-certify and so forth. Another retirement plan change is the increase in plan loan limits for a period of time to allow, again, employees that are affected the ability to access funds in retirement plans. So most of the time, the loan maximum is the lesser of 50% of the vested loan balance, or the vested account balance rather, or 50,000. It has been lifted so that it's 100% of the vested account balance or 100,000, whichever is lesser. So it's giving you a lot more leeway there to get access to funds. This is available for loans originated from the date of enactment, which was March 27th, through September 23rd. So essentially a 6-month period. Eligible loans may be delayed for 1 year, including those that were outstanding prior to March 27th, 2020, but interest will accrue. So even the folks that were taking their loans prior to the date of enactment, they will get a deferment period if they choose to take it, and interest will accrue there. But again, further guidance is needed on how to self-certify for making sure that they do indeed meet the conditions for an eligible distribution or loan. If they fall clearly into one of those categories, that's, if they were laid off or something, that's clear. But if they're sort of on a fine line, then I would wait to find out what the additional guidance is. Temporary waiver of RMDs is another significant change that affects all of us in the financial services industry. And this applies to the year 2020. It applies to IRAs, including inherited traditional IRAs and inherited Roth IRAs. We know that those have post-death distribution requirements for most. It does waive the RMD for those types of accounts, as well as governmental 457B plans, 401k plans, and 403B plans. So it suspends any RMDs due in 2020. So this would include folks that turned 70 and a half in 2019. As you know, the Secure Act changed the RMD requirement to 72 for individuals that turned 70 and a half in 2020 or later. So those folks that turned 70 and a half last year, in theory, could wait until April 1st of this year to take their first distribution. If they did that already, or they learned of this before, they can disregard the RMD requirement in 2020. Now, if they took their 2019 distribution in 2019, they can't reapply that. But if they took it this year or they hadn't yet taken it, they are waived. If they already took it, they can roll it back into the plan without a problem. Again, only applies to distributions in 2020. So that's that there. That's a pretty self-explanatory one. And again, it's only for 2020 at this point. It doesn't affect any inherited IRAs of decedents dying this year. As you know, we're into that 10-year period now for most beneficiaries. It's a moot point for them, because if they died this year, then distributions wouldn't occur until next year. Not even required though, because it's a 10-year payout at the end of the 10. So only inherited IRAs that were already in payout mode would be affected by this waiver. Switching gears to expansion to covered healthcare services related to COVID-19. There's a significant part of the act that added some flexibility in providing preventative care services at no cost, such as immunizations, an evidence-based service or item by the U.S. Preventative Services Task Force. So obviously we don't have a vaccine yet, but if one were to occur, or other developments that they felt would mitigate the risks, those would be covered at no cost. And Medicare Part B premium, or Medicare Part B, will cover the test to determine infection at no cost. There's also an expansion of telehealth services for high deductible healthcare plans. And this is for plan years beginning on or before December 31st, 2021. They are not subject to any telehealth services, are not subject to the healthcare deductible before being available. And Medicare has done something similar as far as broadening ways to allow at-risk seniors mostly to get access to healthcare without having to be exposed by coming into an office. You can find information about the Medicare portion on the Medicare.gov website and what that covers. Another change is one that affects charitable contributions, and this is effective for tax years beginning in 2020. It doesn't have an end date. So, and for now, we'll just assume it's going to continue unless they change this, but they're offering a $300 above the line deduction for cash contributions to qualified charities. As we know, the Tax Cuts and Jobs Act of 2017 that went into effect 2018 significantly increased standard deductions. So a lot of folks couldn't take advantage of any donations they made because that standard deduction was greater than what they could get, even itemizing deductions with the charitable contribution. So at least there's a 300 above the line now, and you can get that obviously whether you file standard or itemized deductions. It also temporarily suspends the 50% of adjusted gross income limit for charitable contributions for individuals. and increases it from 10% to 25% for corporations. Clearly a need here to help some of these nonprofits that are probably struggling. So I'm sure that that's part of the reason. Contributions to private foundations and donor advised funds are specifically excluded. Student loan debt is another section that's gotten some press. One way of thing is the employer assistance on student loans. I'm not sure how many employers might be doing this, but they can provide up to $5,250 of educational assistance tax-free if they use it to pay the employee's loan principal and interest, and they have to do that by December 31st, 2020. The one of more interest, though, is the federal student loan payment suspension. It's called administrative forbearance period. The press I've seen on it is, unfortunately, it only applies to federal student loans, not personal loans that have been taken out for that purpose for now. But the payments on those federal loans are automatically suspended without interest accrual from March 13th through September 30th, 2020. So that could give relief to a lot of folks that have those student loans. Okay, so unless you have anything, Chuck, do you have anything that you can think of off the bat before I switch over to small business relief?
No, please go ahead.
Okay, so let's switch gears and talk about the small business relief. This has gotten a lot of press, as it should, because a lot of businesses are clearly economically impacted. So there are several provisions within the CARES Act that are intended to aid small businesses. The first is tax credits for required paid leave. This was actually not part of the CARES Act. This was the second of the three phase, the phase two, if you will, called the Family First Coronavirus Act. And it provides a fully refundable tax credit for small businesses required to pay sick leave or FMLA to an employee affected by COVID-19. It'll cover up to 10 days of sick leave pay and up to 10 weeks for FMLA, and that will be government funded. It includes employers' share of Medicare taxes as well as healthcare expenses. Eligible employer is not subject to Social Security taxes on these eligible wages for this purpose. And it's available to businesses and tax-exempt organizations with fewer than 500 employees from April 1st, 2020 pay periods up through December 31st, 2020. Another credit is the employee retention credit, and that is a fully refundable tax credit for up to 50% of qualified wages plus qualified health plan expenses not included in the employee's income, so paid by the employer. The eligibility period for that is March 12th, 2020 through December 31st, 2020. And the max wage that's covered per employee is $10,000 per calendar quarter. But that is a fully refundable tax credit. Eligible employers are those that are fully or partially suspended operations on any calendar quarter in 2020 due to the pandemic, or have experienced a significant decline, 50% or more, in gross receipts in the quarter as compared to the same quarter in the preceding year. It's important to note that there's several small business aids, and one of them, which we'll get to, is the payment protection program. You just don't want to overlap or double dip, I'd say. Use the credit and the 8-week period that you're using the PPP funds, because then the PPP funds wouldn't be forgivable. So just make sure that they know that. Delay of employee payroll taxes. This is just, giving some easing to payroll taxes from March 27th through December 31st. It allows employers to delay the payment of Social Security tax at 6.2% that's paid by the employer rather. They can opt to pay instead 50% by December 31st, 2021, and the other 50% by December 31st, 2022. Qualified payroll taxes are the employer portion of FICA, or 50% of the self-employment tax for self-employed individuals. There's a modification of net operating losses. I noticed, I think it was yesterday, the day before, that there's a new revenue procedure that explains this well. That's located here at the bottom, the 2020-24 revenue procedure. But it temporarily amends the net operating loss rules to allow net operating losses incurred in 2018 through 2020 to be carried back for 5 years, and removes the taxable income limitation. So this is designed to just give some liquidity where it might not have been there. It obviously does require an amendment of tax returns, but could help businesses in this way. And then the loss generated in prior years may also be used to offset 100% of taxable income for 2019 and 2020. Again, if that's something that you're interested in finding more information about, visit the irs.gov website and look for Revenue Procedure 2020-24. So let's switch gears and talk about the Payment Protection Program. This is one that had $349 billion allocated to this program. I'm pretty sure that they've either exhausted the funds or that's going to happen today already because of the mass influx of applications that banks have received. But there is the potential for $250 billion more if Congress can pass that phase 4, it's called. They're being cranky in the Senate right now, but hopefully that will pass soon. But it's designed to help small businesses with less than 500 employees. Some eligible employers can be greater than 500 if they meet the SBA's size standards. You can find all of that information on sba.gov. It includes individuals that are sole proprietors, independent contractors, self-employed persons, nonprofits, 501c3, 501c19 veteran organizations, and tribal organizations. I've heard from many people in reading the news that there have been banks that have just shut the doors on it or have limited it to their existing customers. That's a frustration. But I would encourage you, even if the funds run out, I would encourage you to have your clients that are considering doing it do it as soon as they can, hoping that that next influx of monies comes in to support it. The criteria for a PPP is that the business has to have been in existence on February 15th, 2020 or earlier, obviously adversely impacted by the coronavirus, and it specifically excludes household employees for purposes of this loan program, which can be 100% forgivable, like nannies or housekeepers. So how do they figure out the maximum loan amount? It's the lesser of $10 million or an amount calculated using a payroll-based formula. That formula is the aggregate payroll cost for the last 12 months minus any compensation to an employee that exceeds $100,000 divided by 12. That average monthly payroll determination is then multiplied by 2.5. The 2.5 is designed to put some padding in there for expenses like mortgage, rents, utilities, and overhead costs. But this program was really designed to help keep employees retained or rehired during an 8-week period that starts from the date that the funds are received. So it's essentially saying, hey, even if your employees can't work for you, let's pay them as if they did, like they were on regular payroll for that 8-week period. Now, obviously, anyone applying for it is going to have to provide, payroll records, tax returns, and so forth to figure out what that payroll formula is for them. But it's designed to just really help keep employees employed during an 8-week period. The other thing about it is that you have to add in an emergency injury disaster loan or economic injury disaster loan that was previously issued between January 31st and April 3rd if it was used for payroll costs. Essentially, they're not letting you double dip into different loan programs to pay for the same payroll costs. So that would be refinanced into the PPP. And you also have to subtract out any EIDL loan advances, which we'll talk about in a second. That $10,000 that one might receive from the EIDL side, which is a loan program that you go directly through the Small Business Administration, would offset any funds from the Payment Protection Program. So where do you apply? You probably all know this right by now, but you go to any SBA 7A lender, an FDIC institution, federally insured credit unions, farm credit institution. I would suggest, if you haven't already, if this applies to you or your clients, they should go first to their own bank to see if they are offering the program and apply quickly. Because a lot of them, like I said, I know Wells Fargo has now limited it to folks that have business accounts with them or electronic accounts with them. So a lot of people have expressed frustration, at least the calls that I'm getting. So just, continue to look for a bank that is still accepting those in hopes that we will get this additional funding. So you want to make sure, obviously, the institution is participating. The Small Business Administration does guarantee 100% of the loan. The rate of the loan is 1%. Now, if you've seen anything the Act itself said, the rate would be not in excess of 4%. Then it was revised down to 0.5%, and then that wasn't enough incentive, according to Secretary Mnuchin, so it was then changed to 1%. So if you've seen iterations, you're not crazy. It did change a lot. The maturity period also changed. In the act, it said it was going to be a 10-year loan period for unforgivable portions. Now it's a 2-year maturity. Only one payment protection program loan can be granted, and the loan must be made on or before June 30th, 2020. Again, I think hopefully most people that are doing it have already put their applications in. It started April 3rd, and then it was a phase 1 and 2. And then on April 10th, which was last Friday, it was open to independent contractors and self-employed individuals. I will tell you that on the payroll costs, there's tons, like I said, there's tons of guidance on treasury.gov, especially, and the SBA website. But independent contractors that are in your employ have the ability to request their own PPP. So you're not going to include them in the payroll, average payroll costs. That's one question that I've gotten often, and they've given guidance saying, hey, don't include an independent contractor because those folks can go and apply for their own loans.
Heather, really quickly on that, I know there's a form on the SBA site versus your regular bank. Have you seen the difference between that? You can go on the SBA and fill it out. How does that work, or with your individual bank?
Yeah. So you mean which one, for the EIDL or the PPP on the SBA
PPP.
website?
Yeah,
I know that there's a standard loan application on the SBA website, but I would start with that, but definitely go and fill the one out for the bank if they have their own form. But there is one on that website for sure. And there's also the SBA loan app for the EIDL program on the website. I don't know if that answers your question, but.
Thank you. Yes, it does.
So the big thing about the payment protection program is its ability for loan forgiveness. So the loan will be forgiven to the extent that the employees are kept on payroll for an 8-week period, beginning on, like I said, the date that the funds are distributed to the employer, and for 8 weeks after. It's really designed, this program itself is really focused on incenting employers to just retain or rehire employees so that they have some income coming in between, for that 8-week period. Obviously, they wouldn't be also applying for unemployment at the same time, so it would be one or the other. And the money has to be used primarily for payroll costs, which does include healthcare, rents, utilities, and mortgage. Rents and mortgage on buildings that were there obviously before February 15th is the date. And at least 75% has to be used for payroll costs, including the benefits like retirement, healthcare, and so forth. Again, lots of valuable, frequently asked questions about this. There has been an interim final ruling, and then there was a second interim final rule that really goes into the Q&A about how do you calculate payroll costs, particularly if you're a self-employed person with a Schedule C. That can be found on the treasury.gov website. So I would encourage you to look at that. You got to submit payroll records and other statements at the end of the 8-week period. I've perused some of the big websites like Wells Fargo, and they're all pretty much consistent with showing, payroll for the last 12 months, your 940s, your 941s, those kinds of things to substantiate what you're asking for in terms of the PPP amount. Same documents will be required again after the loan is complete, after that 8-week period, to get the loan forgiven. I was on another call with a CPA that had a great idea, and he said, that you should consider establishing a separate business account for the payment protection plan loan, because it's easier from a record keeping standpoint to show how the money was coming in and out and how it was used. So that was a very good point that I wanted to pass along. And the amount of forgiveness would be reduced if the headcount declines or the salary or wages are reduced. So you have to be mindful of that. Now it's headcount, so it could be one employee being replaced with another, and that wouldn't be a problem. But if headcount reduces based upon what the PPP was calculated on, then it's going to affect the amount of loan forgiveness. What's considered payroll costs? Wages, salaries, tips, payments for vacation, family, parental, or sick leave is also included. Again, remember, we don't want to double dip, so we can't use an 8-week period where the employer is also trying to take the credits, the advanced credits from, for the FMLA or sick leave and so forth. Group health and retirement is considered a payroll cost, as well as state and local taxes. For independent contractors or self-employed individuals, which is the case for a lot of us in the financial services industry, you would look at wages, commission, income, net earnings from self-employment. Certain exclusions include employees whose principal residence is outside the U.S. You would not include them in the payroll calculation. And then, as I said earlier, compensation of an individual in excess of 100,000 is excluded, and federal employment taxes withheld between February 15th and June 30 are also excluded. So let's switch gears and talk about the economic injury disaster loan. And there's an advanced portion of that, which is essentially called a grant, and that can be up to $10,000. One of the questions I've gotten is, can you apply for both? The answer is yes. You cannot obviously use EIDL funds for the same payroll costs as you would use the PPP for. So somebody might say, well, I'll use the PPP strictly for payroll so that I know it's going to be forgiven as long as I don't reduce headcount or salaries and so forth. And I'll use EIDL funds for other things. But they can both be applied for. There is also in the EIDL application an option to apply also for the $10,000 emergency grant. It is supposed to be made available within 3 days of successful application. I have to be honest, I haven't spoken to someone who says, yes, I did that, and within 3 days I got it. Not to say that they haven't, but I haven't talked to anyone about that yet. Unlike PPP, this program is administered directly through the Small Business Administration. And I want to point out the 10,000 by head count. So if you are a self-employed person that is receiving 1099 income, which I suspect some of us are, and it's only you, then you're not going to get the full 10,000. It's going to be by head count. So if it's only you, it's going to be 1,000. And it will be used, whatever amount you get from this grant will be used to offset any PPP loan forgiveness. So keep in mind, keep that in mind as you're doing it. And another critical part is if you apply successfully, you get the EIDL grant, but your application for I'll call it the non-grant portion of the EIDL is later rejected for any reason, you can keep the grant money. Again, if you've got the PPP though, make sure that you offset your loan forgiveness by that amount. The grant can be used for sick leave for those affected by COVID-19, to maintain payroll. Don't want to duplicate, though, what the PPP is covering, to meet increased costs to obtain materials, rents, and mortgages. Again, not the same ones that you're using if you use 25% of the PPP for those things, or to repay obligations that can't be met due to revenue losses. So let's talk about the non-grant portion. So again, I've said it again, Small Business Administration is the one that administers this. You can find the application for it on the website. It's up to $2 million. Emphasis is up to. The SBA will determine the amount that they will lend based upon the level of economic injury. And that will obviously be determined by the payroll, the things that you supply them. The interest rate on this one is 3.75 for small business owners and 2.75 for nonprofits. So remember, the PPP is 1%. So there is an ability to roll the EIDL loan into the PPP. Obviously, the EIDL portion isn't forgivable, but at least it would be at a 1% rate. There is a longer term repayment, which is up to 30 years. Again, that's determined by SBA. Isn't it automatic? It's also that the term of the repayment is based upon the level of economic injury and the business's ability to pay. Payments can be deferred for up to 12 months. And like I said, the EIDL loan doesn't have to, but it can be refinanced into the PPP. The only time the EIDL has to go into the PPP is if it was taken out January 1 through April 3rd and was used for payroll costs. But I would probably refinance it in so I can get a lower rate myself. But that is an option. The criteria for an EIDL non-grant portion is slightly different. The business had to be in existence prior to February 1, 2020, whereas the PPP is February 15th, 2020. And then there's an SBA Express Bridge loan. Again, you can find all of the loan options on the SBA website, but it is specifically for small businesses with an existing relationship with an express lender, and they can access up to $25,000 quickly. And then, of course, when they get their EIDL, they'll pay it in full by the proceeds of that EIDL loan. And here's the sweet spot. So again, fluidity is the word I would use to describe the CARES Act. And so you really would be, it'd really be a good idea to, take note of these various places. These are the ones I check every day. because there's always additional guidance. What I'm patiently waiting for is the guidance that should hopefully come on the coronavirus related distribution, because I do get lots of questions about that. And like I said, I'm not eager to tell people, yes, use that as an opportunity to get the money that you wouldn't normally be able to get from a qualified plan to roll it as an in-service withdrawal. It's not really the spirit of what it's for. So I'm not comfortable with that until the IRS gives guidance. But the U.S. Treasury has a ton, even more guidance on PPP than Small Business Administration does, honestly. And you can find the link there. The IRS website has all kinds of information about the stimulus payments. Like I said, the non-filer information, the where's my payment information, as well as new employer tax credits, high deductible health plan information, and just individual and family information in general. And then the Small Business Administration obviously covers the guidance there. Loan Resources, Department of Labor has a coronavirus related page. They all have coronavirus related pages. Federal student aid, if that's something that you're working with or interested in knowing more about, they have a studentaid.gov section of the federal student aid website that deals exclusively with that. So that's where we are. I know that was a lot to cover. I don't know, Chuck, if you have any additional comments or questions or.
No, Heather, I really appreciate that, though. I mean, and particularly this last slide. Those of you, want to take a picture of it, whatever, make sure that we'll try to get that out for folks as well, just as a resource, because I think there are so many different programs available right now, and making sure that members understand the dynamic of how to take advantage of this to help your business, because I think it's really, really important. So thank you so much, Heather, for the information you shared today. Again, it's truly, it's very difficult to be an expert in this area because, you had like 20 days to understand it. So I really appreciate it. So
You're welcome.
It's truly enlightening.
Well, good. And I would, again, just encourage the financial folks that are listening. This does, the small business loan program, the PPP, does affect a lot of you. I think you've had a lot of questions about it. So really do go look at that. The interim final rule, the second one that was issued, look at that, because that has some great information about self-employed people that file Schedule C and how to calculate things and what period of time to measure and so forth. So really valuable information at all of these websites, but certainly for financial professionals looking to take advantage of the PPP, and hopefully the $250 billion will be fast on its heels so we can replenish the program.
Yeah, and I think the other important thing is not only for yourselves as members, but your clients that are small businesses that also might not have the resources that you have available to us right here, and we can share those with them. So again, really appreciate it. The webinar was recorded and will be available on our website for anyone who could not attend today and those wanting to review the content at a later date. If you're not a NAFA member and would like to support our education and advocacy initiatives in support of the annuity industry, as well as obtain access to our archive presentations, please go on NAFA.com and click membership and join NAFA. Our next webcast is scheduled for this Tuesday, the 21st, and we'll have Josh Woodbine and Isaac Norton of Midland Financial discussing the fountain of youth dilemma, the risk of longevity and retirement. So again, thank you, Heather, and thank you all for your time and attendance today. And this concludes our webcast.